In the early stages of the home buying journey, many buyers begin by seeking a pre-qualification. As a real estate professional, it is your duty to understand what this term means, how it differs from pre-approval, and how it should and should not be used in practice. A buyer's level of mortgage readiness directly impacts their ability to make offers, and your responsibility is to guide them with accuracy and care. What pre-qualification involves. Explanation of pre-qualification. Pre-qualification is a preliminary, non-binding assessment of a buyer's financial standing. It gives the lender a high-level view of what a borrower might qualify for based on self-reported income, debt, and assets. There is no verification of documents and usually no credit check involved. It's like a quick financial snapshot, not a full health check. Key features. Conducted online, via a lender's website, or over the phone. Buyers provide estimated income, monthly debt payments, and available savings for a down payment. Based solely on the buyer's word, no W-2s, tax returns, or credit report. The lender provides an informal estimate of the loan amount the buyer may qualify for. It is not a commitment to lend and carries no legal or contractual weight. Real estate example. A buyer calls a lender and says, "I make $85,000 a year and have $500 a month in debt." Based on this information, the lender pre-qualifies them for a $400,000 loan. No documents are submitted, and the lender does not pull a credit report. The buyer receives a pre-qualification letter that outlines estimated borrowing power, but this estimate is not guaranteed. Benefits of pre-qualification. While limited, pre-qualification still has useful advantages, especially in the early stages of the home buying process. Benefits for buyers. Helps establish a realistic price range. Example. A first-time buyer believes they can afford a $500,000 home, but after a pre-qualification call, learns they likely qualify for only $375,000. This realignment helps avoid wasted time and disappointment. Quick and convenient. Most pre-qualifications take less than 15 minutes and don't require document submission or credit impact. Early financial awareness helps the buyer understand how income, debt, and savings affect loan eligibility, which can motivate them to improve finances if necessary. Benefits for agents. Allows you to assess buyer seriousness. If a buyer hasn't even taken this first step, they may not be ready to purchase. Provides a starting point for financing discussions. Agents can help connect buyers to reputable lenders and explain the next steps. Best practice tip for licensees. Encourage all buyers to complete at least a pre-qualification before scheduling showings. This ensures their price range aligns with their financial capacity and saves time for everyone involved. Limitations of pre-qualification. Despite its convenience, pre-qualification has significant limitations that can lead to confusion or even contract failures if not handled properly. No document verification. All financial details are self-reported. A buyer may accidentally inflate income or omit debt, leading to inaccurate estimates. Example. A buyer claims $6,000 month income but includes bonuses that are irregular or unverified. The lender pre-qualifies them based on this amount, but during underwriting, their actual qualifying income is only $4,500 a month. This may lower their loan limit and cause issues if they're under contract. No credit pull. Without seeing the buyer's credit score and credit history, the lender has no way to gauge their risk profile. Credit score directly affects loan approval, interest rate, and program eligibility. Misleading to sellers. A pre-qualification letter does not confirm a buyer's ability to obtain financing. In competitive markets, sellers may view pre-qualification as weak evidence of financial readiness and favor buyers with full pre-approvals. Material Fact Reminder, AAC, R4 28-101I. You must communicate all known material facts with reasonable care. Misleading a seller or another agent into believing a buyer is pre-approved when they are only pre-qualified can lead to contract fallout and professional consequences. Legal standards and best practices. Arizona Department of Real Estate, ADRER, guidance. Although the ADRE does not regulate mortgage lending directly, it does impose clear standards of professional conduct on licensees, particularly when dealing with buyer financing. Statute Rule Requirement AAC R4 28 11001I. Agents must communicate material facts such as a buyer's true financial status with reasonable care. AAC R4 228 11001A. Agents must deal fairly and honestly with all parties. Misrepresentation risk. Representing a buyer as pre-approved when they're only pre-qualified can constitute dishonest conduct, which is a violation of professional standards. Best practice for licensees. 1. Explain the difference between pre-qualification and pre-approval clearly to buyers and sellers. 2. Encourage buyers to move beyond pre-qualification as soon as possible. 3. Disclose the buyer's financing status in the purchase contract. Do not use a pre-qualification letter to imply stronger financial readiness. 4. Maintain written documentation of buyer communication and the type of lender letter submitted. Contract tip. AAR Residential Purchase Contract, Section 2A. The buyer must provide a loan status update, LSU, or pre-approval within 5 days of contract acceptance. A pre-qualification does not meet this requirement unless the seller agrees otherwise in writing. Use pre-qualification responsibly. Pre-qualification can be a helpful starting point for buyers and a screening tool for agents, but it must be used with caution and transparency. As a real estate professional, understand what pre-qualification truly means and what it doesn't. Educate your clients accordingly. Avoid misrepresentation by clearly stating a buyer's financial status in offers. Comply with ADRE standards and best practices by communicating honestly and protecting all parties involved. By understanding the limitations and proper use of pre-qualification, you reduce risk, improve communication, and keep your transactions legally sound.